our weekly Power Hour episode. I am one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. Today, we have tons of topics to discuss. We have Michael Burry versus Nvidia, a maybe surprising battle that we're seeing heat up. We have responses from Nvidia. We have Michael Burry with, I guess you could call it a short report. And we have tons of other topics. We got a lot of questions from the audience. Worst performing stocks in 2025 that we think could do well in 2026. We've got a whole bunch of other topics. Zoom Communications, which had earnings. We could talk about them. But I'll stop it there. I guess, Brett, welcome to the show. What are you most excited to talk about today, and where should we start?
Well, I'm very excited to talk about Mike Burry versus Nvidia. I'm also very excited to talk about what we're thankful for this holiday season. Well, this is I wouldn't call it a Thanksgiving special episode, but we had, and shout out to Tyler for always contributing in the Substack chat there, a lot of good Thanksgiving focused investing questions to look back on the year before. We'll have a little fun with it, look at some stocks that are, leftovers down year to date, what companies are Thanksgiving turkey characteristics, and what in the investment world we're thankful for this year. Maybe some serious and some fun ones to go along with the podcast as well. Let's see what else. We had questions on Zoom earnings, Mercadolibre, is it cheap today? And I guess maybe to tease, we can officially close the Alphabet psychological long, as it's done quite well. We'll discuss that during the episode. But Ryan, I guess let's kick things off with Mike Burry versus Nvidia. This is the biggest news of the entire week in the financial world. He's calling it, what is it, Cassandra? It's not Burry Unchained, it's Cassandra Unchained. That's a new
Yeah.
Substack. He's probably already got over 1 million in ARR there. Not that he probably needs it, but take us through what his thoughts are. He took down his fund. He's speaking publicly now, and he's back to the old blogging days.
Yeah, so for anyone that does not know or has not followed this, because sometimes I think I'm a little too online with this stuff. This this is a high profile sort of short versus public company news, I would say. It's not just like some blogger that has a short report. Michael Burry, famous from The Big Short, and Calling the Housing Crisis, played by Christian Bale in that movie. He has now closed his fund. I believe it was called Scion Asset Management. Closed his fund that I think he was running for about 25 years and started a Substack. So another guy joined Substack. I don't know, I kind of found that funny that just instantly took to Substack, and I believe from what I can tell, the blog has done very well, at least in the first few weeks. And the first thing he posted was basically addressing why he is short Nvidia. And there's a couple noteworthy points that he makes. First, he rebuffs one of the common mistakes people make when comparing the dot-com bubble to today. Like, so I should maybe preface this with the fact that he is short Nvidia and a short Palantir. A lot of people get the nominal exposure wrong, and it's kind of funny seeing how much people talk about him. He kind of addressed some of those points on his actual blog post, and it's funny that he's like aware of everything people are saying. Anyways, so the first one he talks about is people are saying basically, well, dot com's not like today because we have profitable companies today, and we dot com was just a bunch of terrible dot com businesses. So he sort of rebuffs this and says, but rather than being driven by profitless dot coms, the mighty NASDAQ charged through 1999 and into the new century powered by highly profitable large caps, among which were the so-called four horsemen of the era, Microsoft, Intel, Dell, and Cisco. I'm not going to go through the whole report, but I'll get to the gist of basically what he's saying here. He compares he's comparing today's AI spending boom to the dot-com era, but not necessarily the dot-com bubble. It's more the data transmission build out and how there was a ton of excess supply in the telecom boom, which was, I guess, a byproduct of the dot-com boom, and he compares that to today. So here's what he says: "Over the last year, Meta, Google, Oracle, and other hyperscalers have found epic spending plans are a slam dunk boost for a stock's price." Now, I'll pause there. Uh, I don't know if I totally agreed on this. So he basically says, like, announcing higher and higher CapEx plans is exciting investors. I think to some degree that's true, but you also see a lot of pushback from investors worried about CapEx. Like, a lot of people are asking the same questions. What's the return on this going to be? And they've been able to look past that because they've seen revenue growth, earnings growth, and the CapEx is growing as well. But if you just took out the CapEx plans entirely, like say they were just flat over the last few years and you had the same top line and earnings growth, I think you still would have got good share price reactions probably.
Well, of course, Ryan, less capital expenditures are better, all else equal. I think, and I agree with you that it's not just the capital expenditures, but what I think people are looking at is such a high, hundreds of billions of dollars a year at this point, with right now what looks like really, really strong returns on invested capital. And I think what Burry is about to get into here is that either, and you can correct me if I'm wrong, what is arguing. I didn't read his newsletter yet. He's either arguing that these are a mirage, overstated, we're in a bubble period, so it's going to look good for a while, and then the cash flow is not actually going to show up. So the ROIC, return on invested capital, looks good for all this capex right now, but then is his argument that it's going to fall off a cliff.
I don't know if he used the term fall off a cliff, but he basically asked the same question everybody's asking, which is what is the real useful life of the GPUs? And that seems to be, I don't know if more the weight of the economy has ever rested on such an important accounting question
Yeah,
is
if
how
you're the accounting department at any of these big tech firms, you have big, big decisions to make that are going to flow through to the entire stock market.
yeah, it's I don't know. I'm gonna go into more of it, and after reading his posts, I'm still kind of on the fence. Like it hasn't get all that it's made me realize is there's a lot at stake purely based on one depreciation schedule question and whether or not it's right. But let's keep going for a second. He used this example from a book called Capital Account, a fund manager's reports on a turbulent decade. It's basically, can't remember the fund manager, but his account of the 1993 to 2002 period. And the book says by 2002, less than 5% of the data infrastructure so rapidly built out during the bubble was actually lit. So they were only using, so I can't remember the stat that it was like internet usage was doubling month over every month or whatever it was during the
Oh,
dot com.
that was a fake stat, actually. It's kind of a what's the famous quote? Lies, lies, and statistics, something like that. I think you've probably heard. I might be getting it wrong, but something like that before, where there was just this. Someone must have just said this or come up with it using wrong data that internet usage was growing 100% month over month. But when you look back, it was actually completely false. And the almost entire telecom bubble was based on this, and no one actually did the due diligence, which I think is quite a fascinating anecdote on how people can lose their mind in crowds.
Yeah, and that's exactly what happened was you had the well, internet usage was growing. The rate of growth was being exaggerated, and you had telecom companies, AT&T's, Sun Microsystems. I'm trying to think of some of the other big ones that are now no longer there really, building out data infrastructure, or telecom infrastructure at such a degree that by 2002, so 2 to 3 years later, only 5% of it was being used. Here's how he compares it to the AI infrastructure spending today. He says the five public horsemen of today's AI boom, Microsoft, Google, Meta, Amazon, and Oracle, are joined by several adolescent startups in promising nearly $3 trillion in spending on AI infrastructure over the next 3 years. Investors absolutely love it. The crux of his short, and really the crux of his essay, basically everything he's saying is the useful life of GPUs appropriate? And by GPU, just chips, because I guess that could include TPUs as well. He argues that it's essentially manipulative accounting. So here's what he says: Meta, Alphabet, and Microsoft started at 3-year useful lives in 2020, and today are depreciating these chips straight line at 5.5 to 6 years, which is a huge jump over 5 years. Now, this is the part that I think caught a lot of people off guard. Michael Burry released this essay, report, whatever you want to call it, and Nvidia responded, but not in the way you would hope. They released a private memo to big investment banks and Wall Street analysts, sent a private memo to them
Didn't
rebuffing.
not us. We didn't get included. Yeah, that's where I get mad. Come on, give us some info too.
So yeah, okay. That's part of the outrage was why was this not released in an 8K? Why was this not public to all investors? If you're going to send out this rebuttal of Michael Burry's points, why not tell the whole world? Why are you only telling Wall Street banks? It feels very much like we need buy-in from Wall Street. It should, if you're the most valuable company in the world, this feels like a very fragile thing to do. I have seen some people say that they're not even sure this was actually Nvidia.
Mm,
So
what?
yeah, they're saying it was maybe like an optimistic Nvidia shareholder or some fund posing as Nvidia. I don't know. It seems like it was. Um, but yeah, I thought that was kind of upsetting that they did not post that for everyone. Michael Burry actually talked about that. Like, why are you A, responding to me and only sending it to investment banks?
Right, he's just a guy in his office. He
Yeah.
obviously has a much bigger reputation than someone like us, but it's no different than just us talking about whether we like or not Nvidia stock. He just has a much larger audience. And I also was not a giant fan of them tweeting things about Google's potential TPU deal with Meta, stuff like that. It all for the company that's generating an insane amount of cash flow and is worth close to $5 trillion, if not $5 trillion as of this recording, feels desperate. And I don't know why they're acting like this.
They care way too much about their narrative. It
Yeah.
does like, I don't get it. And they don't need to. It's not like maybe Palantir needs to care about the narrative because it's based on hopeful earnings, whereas Nvidia, I mean, it is showing up in the cash flow. Like the results are real. And my thinking is just put your head down and focus on the company. Anyways, they responded and basically they went sort of line by line. I shouldn't say line by line. They sort of cherry picked a few points from Burry's report and responded and basically rebuffed them. And they were mainly like accounting questions or concerns. But the other part is they said basically Michael Burry was the primary source for the bearish points. And then a whole bunch of the things they responded to, Michael Burry didn't mention at all. So he said like that he was basically Nvidia said that he was basically calling them the Enron, which he never did in the article at all. And he actually, here was the other part that was interesting. In the second post Burry had, he says, full disclosure, and I bet you did not see this coming. Colette Kress, I think is her name, the CFO of Nvidia. Colette and I are not strangers. Her youngest and my youngest went to school together, played basketball together. Her son went on to be an NCAA national champion for Florida in golf, and we cheered. She is a wonderful person and the consummate professional. I believe Colette 100% on basically this quote she had. What's more, she would know as opposed to him. But here's where Michael Burry provides some useful points. And the big critique here is that some people are worried about the useful life of GPUs being overstated. And then you have a lot of people saying, well, you're still getting full utilization out of 5-year-old NVIDIA chips. Here's the quote with his response. The implication that useful life for depreciation is longer because chips from 4 to 6 years ago are, quote, fully utilized confuses physical utilization with value creation. Just because a widget is used does not mean the widget is profitable to a degree that it is worth more than residual value. The accounting standard GAAP refers to how long an asset will be economically productive and justify its marginal cost, not necessarily how long it will last as a physically functioning widget. And here's the part that I like the analogy. We can all use our iPhone longer than intended, and I try. But at 3 years, that old phone might be just 10% of original value. I can continue to use it if I make myself happy with the poor performance, even if nobody else would want it.
Let me give you a pause to breath there, or take a breath there. And I think this is what he is getting at, and it's something that we've discussed a lot here and really is the crux of the entire thing. If we go through the entire value chain from, let's just start at ASML down to OpenAI as an example, but just as a placeholder. I don't care when we talk about the bubble whether ASML has record return on invested capital. I don't care if TSMC has record ROIC. I don't care if Nvidia has record ROIC, and I don't care if the hyperscalers AWS, Microsoft, Azure, and Google Cloud have record return on invested capital because if OpenAI doesn't have positive economics, then the whole thing falls apart eventually.
Yeah,
Is that what he's saying?
well,
Because look, they can, Nvidia and AWS can state super high ROIC today, but if their end customer demand falls off a cliff because they can't generate a profit, then that is not durable earnings.
yeah, it does feel like that wasn't necessarily the crux of what he was talking about, but yes, I do agree with that. Is
I get
basically
so he's saying is it what is that? Because what's different? I guess what is he trying? What is he trying to say that's not related to that?
so I mean his article basically I didn't finish the second post, so maybe I should finish it before I summarize the whole thing. But it and he also says he's going to do it in like multiple parts. So I haven't really gotten to the point of what is the end game here, but I think he's basically saying they are overspending, won't be able to generate the return on it. And yes, that leads to what you're saying.
Well, the
If
useful life
OpenAI,
looks long right now, but will it be longer? Will it still be like it looks that long because everything needs to be utilized right now? But 5 to 6 years from now, if we see a quote unquote normalization and we return to the 2020 era, well, earnings are going to be down significantly across the board for the hyperscalers.
yeah. Yeah, I think ultimately that's what it comes down to is earnings decreasing as a byproduct of overstated GPU useful lives or TPU useful lives, whatever you want to use. The the thing that I where I get stuck, and this is why I don't really feel like having any interest in owning Nvidia, as they're kind of stuck in this like catch 22 where if Jensen Huang goes on the conference call and he talks about how fast they're innovating, in theory, they are kind of destroying the bubble. They're kind of popping the bubble because if your product life cycle goes from or your upgrade cycle goes from 2 years to every 6 months, there's it makes it way harder to justify 6-year useful lives, right? So that to me is where I kind of get hung up on it. I feel like they're kind of in this sticky spot where they don't want to talk as much about like you have to talk about how they're innovating, but you can't do it to such a degree that it destroys what your customers bought 9 months ago.
Ryan, that was a great that you had that little monologue there because I missed about 10 seconds. I think my internet it does this thing every hour where it jumps down every 10 seconds, but I think I understand what you're saying there. And I agree. I'm on the sidelines. I'm just not touching any of this because I do not know what is going to happen. Have some comments here in the chat that say, I got into a debate with someone about CoreWeave's business model. We couldn't agree on the useful life of their GPUs. Yeah, I put it in the too hard pile right now. Now, let me use this question from the comments here about, unless Ryan, you have something to add before we move on.
Yeah, I will just say I did not really care that much about whether this was boom or bubble until Nvidia released a private memo to Wall Street analysts. That
That
is
took you
when
over the edge.
all of a sudden it was like, what are we doing? Like, is why are you hiding? Why are you so afraid of someone being pessimistic? Who cares? If
Right.
your business is legitimate, who cares? And so, yeah, it just all felt more fragile to me the moment after they did that. And I don't know if this is a byproduct of Google's success, but we're seeing I think Nvidia's shares have come down quite a bit from the highs now too.
They have, although this week has been quite the recovery, helpful for people to talk about the returns of the Thanksgiving dinner table. But here's a question from someone in the chat that says, "What are your thoughts?" And this will relate to the Google stuff as well. What are your thoughts on Meta's drawdown? I haven't followed them closely, but I believe given what Zuckerberg has said about the hundreds of billions of dollars in potential spending over a 5-year period, which I think he meant also could be over $500 billion, I think it's probably warranted to have a little skepticism to bring the multiple down a little bit. But if you're a believer in their long-term business, probably a fine buy here. You just got to be worried about them over earning a bit and that depreciation flowing through the income statement over the next few years.
I want to read this quote real quick. I'm still hung up on this. So I'm going to read this quote from, I didn't realize that Jensen Huang said this a while back, but at an NVIDIA AI conference in March, here's a direct quote from Jensen Huang. I said before that when Blackwell starts shipping in volume, you couldn't give hoppers away. If you're still looking to buy a hopper, don't be afraid. It's okay, but I am the chief revenue destroyer. My sales guys are going, oh no, don't say that. There are circumstances where hopper is fine. That's the best thing I could say about hopper. There are circumstances where you're fine, not many. So that is
Sounds
him.
like sounds like fast depreciation.
Right. That is him trying to promote the newest product, but it is a comment like that can wipe out trillions in market cap. Like, I'm surprised that wasn't more talked about. That is a huge like, maybe he's just trying to be promotional, but I bet all their customers are just wincing when he says something like that.
I agree. I agree. All right. Next topic. It's been using the Bill Ackman famous saying on his psychological short on Herbalife. It has been a very good day for our or a good month for our psychological long. My psychological long in Alphabet. You're true. You actually own the stock in Alphabet of about 100% over the last 6 months. Before I get into it, what are your thoughts on the Alphabet move? Did you see any of this coming in the last month? It seems like a random timing. Maybe it was around the launch of Gemini 3. Not exactly sure, but that the move was already happening. W- why is it up this month and not any other?
Yeah, I think part of it's the Gemini 3, part of it's the TPUs being sold, and then
Rumors
people
about that, yeah.
people seeing them as a legitimate competitor to Nvidia. I couldn't tell you exactly why the stock is up this month specifically, but the the narrative the narrative around Nvidia could not have changed more in the span of 6 months. Like, if I take you back to April 2025, Apple's VP of services went under oath, whatever, went into the courts and basically said, "Our mobile search volume declined for the first time ever because people are switching to AI." We had the DeepSeek model throw everything into a wrench and question everyone's spending on GPUs. We had Google reporting their slowest paid clicks growth ever as a public company, and ChatGPT seemed better. Like OpenAI seemed to be better than any other model out there. Then they released Gemini 2.5, and it seems like since then it has just been positive news after positive news after positive news. Like now they are the only vertically integrated AI player in the world. That's the narrative. And maybe they are, but they own the distribution. So like they own the data layer. They have a lot of like data coming into them through YouTube search, Gmail, etc. They own the hardware layer some to some degree. They've got their own TPUs. They own the infrastructure layer because they use their own compute network through Google Cloud. And then they have the model, if that's its own layer, Gemini, which seems to work very well and seems to be leading. And then they have the application layer. So they are able to distribute all these AI feature improvements directly to customers and distribute, like basically reach billions of people in a day. So that's been the narrative shift. Does it deserve 30 times EBIT?
Yes. Yeah, totally.
Is that
So, yeah,
sarcasm?
I mean, what? They're the yeah, if I mean, who's better positioned in big tech? No one. I'd say this is what I've been preaching for the last 24 months. Not that I've made much money on it. That's why I call it a psychological long. It's something I've written about probably once a week on the Motley Fool going back the last twelve months, simply because it's a great SEO play to just go, this AI infrastructure, blah, 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 is the cheapest, whatever. If people know what those articles are like. Stock's up 82% year to date now. Probably the best performing Mag 7 stock, I believe. It's up over 100% since the tariff tantrum lows in April. That's barely 6 months ago. Recently surpassed Microsoft in market cap. And if it passes Apple, I think personally, as someone who's not super bullish on Apple, very, very bullish on the long-term prospects of Alphabet, that'll bring me great personal joy if that happens. It's pretty close. I think the lesson from this is that you can find alpha in mega caps. Look, I felt 12 to 24 months ago, like there were again, this is why I should have owned the stock, but this is why it was a quote unquote psychological long. Hope other people made money on it. Like there was this thesis around, and it wasn't very popular, as Ryan mentioned, about the full stack infrastructure advantage. I thought that was maybe priced in because I didn't focus this much on this company. I thought it was probably understood by Wall Street. You have so much research dollars, so many research dollars going after that. Like, could just some individual person have a differentiated take that can make money? And apparently, it hasn't been because there's been significant outperformance for Alphabet over the last 6 months. I guess it wasn't priced in. A lot of people are coming around to the narrative now. I will officially close the psychological long. Nice little trade for the listeners there. Um, I'll ask you this though, Ryan. Are you trimming your alphabet position, holding? How are you managing that position?
I sold half of my position
Ooh,
today.
all right. Nice.
It partly because it was just a large position for me. It had gotten to, I think, my second largest. And I just, I've said before that if a stock goes up 100% in a month, I sell it no matter what. Or I at least trim it because I've had that happen once before. And it's like, okay, I could keep holding, but it just feels wrong. I can't help but trim it. If the most profitable company in the world goes up 100% in 6 months, I there is just I have a natural inclination, and it's probably wrong. It's probably a fault. I have a natural inclination to trim.
I
And I
think there's a
think
lot of opportunities in small caps right now. I see plenty of opportunities out there that are better than Alphabet. I think maybe like, look, someone said also agreed with me that it deserves 30x. Like, is it fairly priced? You're probably fairly priced. You get adequate return over the next decade, unless they just totally crush the competition in AI, which seems a little bit unlikely. But yeah, it feels like I think that is good timing there. You can recycle it into some better opportunities in smaller companies. Um, Anything else in there? We have a question about whether one of us works at Fiscal AI, which I should say Ryan does. So contact Ryan. I don't know why you're asking that, but contact Ryan. Find him on Twitter or email us at chitchatmoneypodcast@gmail.com. I should mention you hear us talk about this constantly over the next week, and I think this is actually the last podcast that is going to come out during this special sale. The Black Friday sale at Fiscal AI is going on right now. So if you use our link instead of the traditional 15% discount, you get a 30% discount. Huge, I'd say a bargain, honestly, for the robust software that they have over there. You've seen us use it constantly throughout every episode that we've done here. It's a fantastic tool. I use it every day. Go try it out. I believe they always allow you to have a 2-week free trial if you give in their email. Ryan, is that correct?
Yes, but if you wait 2 weeks, the 30% Black Friday discount will be
Goes
gone.
away. Okay, so either way, you can try it out, then get whatever discount you're comfortable with. But right now, if you're on the fence, if you tried it before, 30% off, fantastic deal. I go try it out with our link, and you can, hey, help out the show along with it. Do you want to hear a little anecdote? You're an Amazon shareholder too, Ryan?
Yeah, not much, but yeah.
Well, I have an anecdote that just shows why I think, and someone mentioned in the chat, Microsoft might be the Mag 7 one to rotate into. I think both that and Amazon could be the cheap Mag 7 stocks to rotate into or move from Silicon Valley up to Seattle for for the net for 2026. So we had an issue with my microphone when I bought a new laptop. The cord that it was using to connect to the computer, it just wasn't, it was making things scratchy. I think the input connection was off and I maybe had the volume on too loud. And we needed to have a specific cord for the input one, which is not a traditional USB, to USB-C on my new computer since a lot of ones are transitioning to USB-C. It was a very, very obscure cord, but I search on Amazon. I make fun of Rufus, but I use their AI tool to kind of find the exact one I'm looking for, and I found it yesterday, and it got here within 24 hours. So like $7, shipped perfectly. Now it's actually too short. I underestimated how long 1 foot is because I thought it would reach a little farther. I'm gonna have to return it and get a little bit of a longer cord, but I just think that is incredible value proposition. I could have gone all over the city spending hours trying to find this at Best Buy and all these different retailers, and boom, it's on the everything store. And that moat is incredible, and I don't fault anyone for, especially given the underperformance of the last year. I don't fault anyone for owning Amazon or buying Amazon right now. I feel like 30 times earnings, they're still under earning. Great value.
Yeah, I kinda had a moment like that earlier this year too, where I bought something that used, like, Shopify's, uh
Oh, 2 weeks? Yeah, 2, it probably took 2 weeks.
yeah, I don't know what's the app? That
Shop app, it tracks the shipping. Yeah, it's a nice tool,
it
but
tracks the shipping. They're not doing the
but it takes
shipping.
2 weeks to get there.
Yeah, and it was just such a nightmare, and it's like it's amazing how a 2-week delivery time in the span of a decade has gone from, "Oh, I can't believe I can get this online," to, "I might as well not buy it at all if it gets delivered in 2 weeks." The
I mean, if it's 2 weeks, what are they on the Pony Express?
it's
What is the problem? I don't get it, but it still happens.
and and then you go and buy something on Amazon, and it's just like it's a realization that people have come to think that e-commerce is everything gets delivered instantly. That is Amazon. It is still a decade ahead from any other service, honestly. Like, if they stood still right now and did not improve their logistics infrastructure for the next 10 years, I think they'd still have better delivery times than UPS.
Oh, maybe.
I could be
But
wrong,
I think
but
the problem might be the retailers, the online merchants paying for cheaper services from UPS, but I get your point. They do have an advantage. I'm not necessarily, it's maybe not UPS's fault. They seem like a very well-run business that's just facing some very tough competition. Either way, they don't have the vertical integration that should sustain Amazon.
An integrated solution makes a huge difference because they're pre-stocking the inventory for you. They've got it at a distribution point based on like volume estimates, probably. I'm guessing
But yeah, well, yeah. I mean,
that they're going to get
of
it to
course.
you. Like UPS doesn't have that advantage. I just don't see. I think today they have the widest moat of any business in the world.
Meg 7. Let's just it's not wider than some other companies.
Who would you put above?
Ferrari and Hermes. Maybe add in Visa, MasterCard, although you could have a debate on that one. I think you could also put in maybe FICO, but that I understand there's some regulatory stuff there. I could also hear arguments for railroads, but of course they're close. Of course they are one of the widest moats out there.
Yeah. Yeah.
Stock exchange, Moody's, stock exchanges and rating agencies, sure. But I mean, they're trading cheaper than almost every company I mentioned there.
Yeah. They're cheaper than Walmart. They're cheaper than Costco. Do you expect the sales volume? Someone just commented Taiwan Semiconductor
Sure,
ASML.
yeah,
Yeah,
yeah. All right, we can't think of every wide moat stock off the top of our head, but thank you.
yeah, it's probably up there too. But it just, yeah, I love Amazon, and I always have those moments where I get something delivered in like 3 hours, and I'm in a suburb, and I think that I just need to own more shares.
Yeah,
And
or own Coupang. Coupang's not bad either. They're faster.
yeah, but I have no, I have no experience with it. It's not like I'm getting the anecdotal evidence. But yeah,
Yeah, that's true. That's true. What was I gonna say? Oh, to close that out, maybe this is gonna be a tease for our 2026 predictions. Could you do not legitimately, but as a prediction trade, long Amazon, short Walmart and Costco for 2026?
I wouldn't short Walmart and Costco.
It was a pair. It's a pair. You're saying that Amazon deserves to trade at a higher multiple. I feel like that's an interesting trade, and I
It's
feel like
interesting. It's not
both.
something I would actually do, but it is.
I'm saying, yeah, but do you think that's profitable over the next, not just 2026? Anything can happen, but over a 5-year period.
I mean, it's difficult because everything we just talked about at the top of the show. If what happens if they have to depreciate? What happens if the useful lives on their
Uh,
chips is significantly shorter than they're currently estimating?
I think they're the least
Earnings.
exposed to AI, least exposed, and they are
They spend
they
the
can make up
most.
for it in e-commerce.
They
What?
spend the most on chips.
Capital expenditure, yes, yes. But I'm saying their growth, they're not as exposed from. They have the Anthropic relationship, but they're not nearly as exposed to AI as Microsoft or Google or Oracle. I mean, if you want to toss them in.
But it would be a huge headwind to earnings. But I'm not. I'm talking about. Forget about big tech. It would be a headwind to earnings, whereas Walmart and Costco would not have a headwind. That's the only concern with
Yep.
that pair
No.
trade.
Yeah. I think it would be profitable over a 5-year period, and I don't think there's the risk of getting totally blown out. Like, would Costco or Walmart go to 100 times earnings and Amazon goes down to 20? Maybe I'm jinxing it, and that's gonna happen because it doesn't make sense that Costco's at 50 and Amazon's at 30. But I feel like that difference there, it's an interesting one for sure.
All right, let's shift gears. What do we want to talk about? How about this? Let's hit some of these Thanksgiving questions.
Okay, yeah. Thank you to Tyler for some thoughtful questions here. I'm thankful for the Tylers that somehow we are loved by people named Tyler that join the chat seemingly every week. I'll say that first off. Let's just go through. We have 4 different ones. We'll go kind of rapid fire. What companies exhibit the most Thanksgiving turkey characteristics, namely companies that have performed well over the past but have tremendous terminal risk? Bonus points if none of the investors recognize or appreciate this. Ryan can probably guess the 2 companies I'm going to say. I'm short both Apple and Tesla. You knew that was coming, right?
Uh, Maybe I could see. I was not guessing that, but I think anything anything with the words terminal risk or short, I expect you to say Apple. So maybe I should say that. But
Terminal, we should say terminal is, and the Thanksgiving turkey analogy is great because for those that don't know, it's the classic. Is it Nicholas Taleb theory that stuff can look like a Thanksgiving turkey where you keep gaining weight and your life is productive and blah blah blah, and you just have a tremendous life over 364 days, and then one day everything goes. Uh, Try not to swear, but everything goes to hell in one day. So I think that one is a good analogy of potentially over a decade, 2 decades of something that you're seeing the lack of innovation, and it's not showing up today because everyone's locked into the ecosystem. But eventually, if they turn into IBM from an innovation standpoint, that's going to matter. It's not going to matter next year, but it could matter over 10 to 20.
yeah, my gut goes towards retail on these, like retail concepts. It feels
Ooh,
like,
Target?
yeah, but Target's already done so poorly.
Target before this year? Yeah. Nike? What about Nike?
Yeah, Lululemon maybe, but I could easily argue the other side of that too. But anything where it's like
Chipotle. Oh, here's
trendy.
one. Chipotle. It's already hitting a bit
Yeah,
because
that's what I mean, but these are in the rear view.
yeah,
All these
yeah,
companies we're talking
true.
about are on the top 20 worst performers list of the S&P 500 this year.
Yeah, stocks that are at all-time highs. It's weird that there's a lot of stocks down, and basically there's just a few companies dragging up the S&P. Not great when breadth is that low. I had a hard time coming up with one of these because, as you mentioned, a lot of stuff that we look at has kind of turned into, the turkey that's dying and potentially either a falling knife or a value play. I don't know.
We
What do
have a
you have
di
any
we have
ideas?
a dying turkey portfolio. Yeah.
Yeah, what do you have?
Well,
What
Fiserv
about?
was a good example of one
Sorry?
that was Fiserv was a good
Oh yeah, yeah.
example of one that was significantly over earning. Now that might have been like just outright accounting manipulation, but it's pretty tough to predict that kind of thing in advance. And if you do, you have to know a business really, really well. And typically, the only times where I felt very confident in calling a company a turkey before Thanksgiving is one where I've been long and I've owned the company, and you kind of get to see, okay, they are over earning, the stock price is too high.
Sorry, who did you mention? I was reading something. What
I
before?
didn't call out a specific
Oh, you
name, I
call.
don't
Okay,
think.
okay, okay.
Okay, Sprouts Farmers Market. When they
Yeah, yeah, that
were
was a good
trading
one.
at
Yeah.
$180. I know it's obviously in hindsight, but we followed that company for a long time, and once you're long a company, it becomes much easier to say this is an extreme valuation. Sometimes maybe it hurts you, but
Ooh, I got a good one. I got a good one. This is from the comments. They did say that I don't know if I agree with this one, but it's 1 year long. Adobe, but the second one could easily be one. Uber.
I
The Waymo
disagree
risk
with
could be
both of
real.
those. I
What?
disagree with both of those.
Now I disagree on Adobe, although I don't know it as well as you, but
What don't you like
Uber,
about Uber?
the fact that Waymo in probably 4 years is gonna cover 99% of the population of California?
Are they going to be ordering those rides through Uber?
No,
Are they doing that now?
no,
No?
no.
Really?
I do not believe so in California, although it gets I should say 90% confident on that one. It gets confusing on what states are using Uber versus not.
Okay, we've
He,
done an Uber trade before. Uber versus
it's
Airbnb.
ongoing. The permanent Airbnb versus Uber market cap.
Well, we initially had
I
I
Uber is winning, but I'm holding strong for the long haul. I think Airbnb will eventually be worth more.
we initially had a 3-year lifespan on that bet, but we can go ahead and make it
We've
perpetual.
extended. Well, yeah, the first one, but I'm saying we're doing it for a long time.
You sound like the big tech accounting departments with
Yeah,
the
we're
useful
extending the
lives.
yeah,
We're extending
yeah.
the useful life of this bet. Um, I'll make another one with you. In 5 years, Uber has more monthly active customers than they currently do.
Do they disclose North America? Because I would do that North America.
They don't break it out by geography.
How about, adjusted for inflation, GMV in North America? Do they break that out for mobility? Because I wouldn't do anything that's not just North America because I think that timeline is too short, just given their international success.
Let me check fiscal real quick, and I will let you know.
Alright, while you're looking, I came up with some other ones that I think could be the Thanksgiving turkeys, and they're companies I do not wanna own, and it's legacy banks, legacy, investing brokerages. I think if you look at the disruptive players in this space, for example, in the banking space, SoFi, I'm not saying it's a great business to buy today, I'm not saying the stock is overvalued, but they're taking on a ton of deposits, and I think over the next 10 years, it'll start to be meaningful versus the big banks. And then especially if you look at investing brokerages, I do not understand why someone wouldn't use Robinhood or Interactive Brokers. Well, I'll say because they're our sponsor and I use the service myself. Interactive Brokers number one versus the Charles Schwabs, the Fidelities, the what any of those other players out there. I think they're going to slowly because the reason people went to those places before is you could bundle in like index fund stuff, all that, right? But now there's no you can do anything you could have done and can do on Charles Schwab, you can do on Robinhood or Interactive Brokers. I think they are potential, I'm not saying it's gonna happen, but potential, Thanksgiving turkeys over the next 20 years.
Yeah, but I think that's, like, not the point of the Thanksgiving turkey analogy. I think the point is that, like, earnings get crushed. Like, it goes from being
Yeah,
a
yeah.
great business to being
Okay,
slaughtered the
okay.
next day. I could see
That's
a
very
slow
hard to
bleed.
predict. If you can actually predict something that just 1 quarter gets destroyed, you can be very, very good at shorting. I don't think I have that ability.
So, Uber reports US and Canada revenue. Now
For
keep in mind
mobility?
that that does include deliveries. I don't think they break out mobility based on geography.
We can come up with something. Maybe we save it, table it for the predictions episode. Figure out something that um, could be more palatable for a direct Waymo bet.
Okay, the United States and Canada revenue accounts for 50% of total revenue, more. So, monthly active platform customers, I would guess, is majority North America.
Yeah, but it could grow significantly internationally. It could, and there's
But
a
so
lot of
then
people
that
that live outside the U.S. So I don't know if that could just swing things.
I don't know. Okay, I would just whatever it is, maybe we can find a metric and we can present an official
Mhm.
bet, but I would say I would take the flip side of the to the commenter who said Adobe and Uber. I think both of those businesses are bigger in 5 years.
Yeah, we have a comment here. Monthly active platform customers are growing 20%. I think that is the point of that is the definition of the turkey potential bet, but that's international included. Now, if we can look at strictly North America, I'm definitely game. All right, we got to keep moving. What area of the investment world are you most thankful for in the past year? I'm going with more market focused stuff that allows us to have fun time on every investing power hour. I am thankful for MicroStrategy coming back down to earth, coming back down to their net asset value, down 50% in the last year. So the traders with insane egos that at this time last year were calling everyone on Wall Street like said 99% of investors can't understand this trade because it's so complicated, but once you do, you'll understand it's the best investment out there. Well, the stock's down 50% since then. And I will admit I have some schadenfreude for that because I think it's a nonsense company promoted by a terminal fraudster. hopefully don't come after me legally on that. I say that jokingly. But am smiling thinking about them talking with their families at Thanksgiving and having to explain why they got grandpa into MicroStrategy at $400 a share.
Yeah, that's definitely some I don't think that's quite the Thanksgiving spirit this question was intended for, but
That is what I am thankful for. It gives us plenty. MicroStrategy is not giving us any shortage of things to talk about, which I enjoy.
I am thankful for Google.
Sergey Brin, say, sir, come on. That he
I'm
made you a lot of
thankful.
money this year.
Yeah, I'm thankful for that. I I don't know. I'm just trying to think of stocks that have done well for me. I am thankful
I'm
for
thankful
Bomb
for
Kim.
publicly traded airports.
Yes. I wish I had more stocks to to say I'm thankful
I'm
for.
thankful for Sam Altman for
Oh, I'm
giving us things to
thankful.
talk about every week.
I'm thankful for all the people that choose to use Zins.
That's nice. You're
Um,
still a Philip Morris shareholder?
I am not to the same degree I was. I cut that one in half as well. So that's kind of what's happened. Is I trimmed both Alphabet and Philip Morris once I thought they got when
I mean, the market caps are sizable
they
now
both
relative
had
to their opportunities.
doubles in their multiple in a year, less than a year.
Yeah. No, yeah. I don't think you're gonna regret doing that. I'm thankful for the AI boom or bubble because even though Ryan gets sick of it, we do have plenty to discuss each week, and it helps with listenership. That's for sure. Anything else, Ryan, before we go to kind of a buy the dip category
I'm
for Thanksgiving?
thankful for the Remitly haters for giving me this opportunity.
Now,
We'll
can
see.
management repurchase 25% of their stock over the next 12 months? Do you have the guts? What's his name? Matt Oppenheimer. Do you have the guts to do that? Because you have the balance sheet to do that, and I would hope you would take advantage of this stock price. All right, what investments are the best Thanksgiving leftovers? Namely, what are some companies which have gone up year to date, but have the opportunity to continue increasing in price over the rest of the year? I'll go one, the perennial compounder. People are going to roll their eyes. Nelnet. They keep compounding and compounding. And I'll go another one that I bought this year, Interactive Brokers. I think if there's a bear market, they'll fall out a bit. They're kind of a high beta stock, but over the long term, how much market share they consistently take makes them cheap. And then the third one I'll put is the airport operator in Monterey. If you want to do short term plus long term, they're hosting the World Cup in June of next year. A lot of international traffic going to be flowing through that airport. That is combined with the first year under the new concession contract that is going to be signed later this month, or excuse me, in December. Feels like feels like a good opportunity to me. Ryan, let's go quick here so we can talk Mercadolibre and Zoom too. But what do you have?
Yeah, I don't know if I have any that are super top of mind. I would say maybe American Express, that they've had a good year. The multiple's a little pricey now, but I think there
I hope
still
they
could be
come
some
back to
room.
earth so I can buy. But ooh, here's a good one. New Bank,
Yes.
New Holdings. Yeah,
I'd argue the same for Coupang. These are companies that
yeah.
have done well this year, but it, it's the companies that I am thinking of are the ones that have done well, but there hasn't been a massive repricing in the multiple. Now, Coupang doesn't exactly fit that. They've had some multiple expansion, but when you have stock price basically following fundamentals that and the business quality hasn't changed that much, that tends to be a recipe for still good future returns.
Yep, I agree. Okay. Last one. What are your Black Friday deals? Stocks down 20% year to date. Other listeners said, what losers of 2025 look best going into 2026? And in the Substack chat, which people should join, completely free. It's fun to talk about the podcast during that. Someone gave an exclamation point as a reaction. So it sounds like people want us to discuss this. You made a little chart here. What came to mind, and one that I'm studying right now, I don't know if it's cheap, but I have to still finish my estimates, is Kava. Very interesting concept. Definitely national, going national. I don't know if they have any in Texas if you tried them out, Ryan, but they unfortunately I've never been able to go. That one seems interesting to me. Lululemon. Seems interesting, even though I haven't bought it. Crocs seems interesting. I did buy it, small position, and Sprouts Farmers Market. I think it's come back to earth, and I decided to buy the dip after it fell about 50%.
Yeah, let me just go through some of the worst performers in the S&P 500 this year, and we'll see if anything catches your eye. This is from best to worst of the worst performers. So Target is down 34% year to date. I don't even know how to pronounce the next one. Lyondell Basell
We'll skip it.
down 34%. Centene Corporation, United Health, Zebra Technologies, GoDaddy, Conagra Brands, Baxter International, Constellation Brands. Pause
I'll help
there.
them. I'm gonna help them tonight. Wednesday
It
before
is.
Thanksgiving. I think that's a big holiday for them.
It
Thanksgiving
probably is.
entirely. Yeah.
Moderna. We're getting into the top 10 worst performers now. Dow, Charter, FactSet, Chipotle, Alexandria Real Estate, Molina Healthcare. Top 5 worst: Gartner, Lululemon, Deckers, The Trade Desk, and Fiserv. Anything catch your eye from that list?
Trade Desk, Lululemon, Constellation Brands, and I think that's about it. Maybe GoDaddy, because I feel like URLs are still a durable asset. I'm not sure if they've been mismanaged at all. I know they got into some weird stuff. FactSet, I won't say because I know that fiscal AI is coming for them, right? But
Disruption. Watch out.
yeah, that's the disruption from our sponsor and Ryan's employer. I don't want to say Charter either, even though it looks extremely cheap because they feel a little mismanaged. But anything pop out to you?
I will never touch cable. That's a rule for me. Mainly because I've just seen too many people get burned there and a lot of really bright people get burned. The one that probably sticks out to me, maybe the two would be Lululemon and Constellation Brands. People have been drinking alcohol for 1,000 years, 2,000 years.
Are people going to be drinking Modelo, Corona, and Pacifico 20 years from now? I think you can make a good bet on that.
Yeah. Lululemon, 8 times trailing EBIT. I think if you are betting whether or not Lululemon is going to be, are they going to go the way of Nike or Under Armour over the next 5 years? I would bet they're closer to the Nike path.
Yeah. Buy the dip on
Durable.
the baggy clothes trend, right? That's hurt them, and then they'll eventually figure things out, and then they'll come back to life. It's a good
They
brand.
can they
People
can
like what
shift. Like they can
do women
shift.
still like it, Ryan? Yes or no?
I think so. I've heard some people
Yeah.
complain. I've heard some people go towards the Aloes, the Vioris of the world.
Here's
But
what I've seen though, is those companies do extreme discounting.
yeah, and I mean, there's gonna be there have been competition over the last 15 years. Lululemon hasn't been alone. I just think it is. I think it's a durable concept, still a good brand, and can adjust towards trends over time.
I agree. All right. Thank you for those questions. Do join the Substack chat. Let's go quick as we're running out of time here. People want us to talk Zoom and Mercadolibre. Listener question. Curious what you all think of Zoom. I looked at their earnings. You'll never guess. There is a Zoom AI companion that you can now use. Probably quite helpful. If you can hence catch my sarcasm there. But let's look at the financials because this company's left for dead, but people still use Zoom and they pay for it. Revenue up 4.4% year over year. Enterprise revenue growing 6.1%. And look at this GAAP operating margin 25% and expanding quickly, 8% total growth in remaining performance obligations. If I see RPO, I always think run pass option in my head instead of RPO, instead of remaining performance obligations. EV to EBIT 15.6, EV to gross profit 4.6. Shares outstanding are now falling at a 2.6% annual rate. Ryan, One word answer. Is Zoom stock cheap? Yes or no?
Does it have to be a one word answer?
Yeah, yeah. 'Cause we have no time. We have no time.
Yes. But I
I
have
would say
flip
yes
flopped
too.
on Zoom like 20 times.
Stock probably does fine from here. All right, Mercado Libre. We maybe can explore this one further. Maybe it could be a deep dive someday. Listener question. Love to know if you guys have considered Mercado Libre at 25 times forward EV to EBIT. Probably artificially low earnings right now, and they're growing 40%. It's my top conviction at current prices. Let's look at brief numbers and look at the valuation. 35% FX neutral GMV growth, 49% FX neutral revenue growth, 10% operating margin. I think room to expand given the financial services side of things. Is the stock cheap here? You have 35 times trailing EBIT. Fiscal AI says forward is 28 times, and 2028 earnings they are at 14 times. And they have multiple tailwinds, I think, at their back. Recovery in Argentina, which is not guaranteed, but looks promising. You have lower e-com penetration than other regions. You have the banking and personal finance stuff can grow and take off from those legacy players in Latin American countries. And they're working to build out the vertically integrated logistics network similar to Amazon. I feel like you do well owning Mercado Libre here. It's been an underperformer over the last 5 years, but I think over the next 5 to 10, you probably do quite well owning this stock.
One word answer, yes. I think it's an
Yes to
attractive
both.
opportunity.
Yes to both. I might like Bank a little bit better given the price, but yeah, I think it's interesting for sure. Okay. I think that's going to do it. Ryan, anything before we close out and go to next week?
If you are not a Fiscal AI subscriber, now is the time to do it. 30% off. Lock it in, fiscal.ai/chit chat. I think this will be the last show we do while the Black Friday deal is
You'll have
still
till
live.
Monday. You have till Monday. This goes released on Friday. You have till Monday. At least check it out. Use our link. At least check it out. It's really, really an awesome service. I use it every single day. Okay. As a disclosure, we're not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in. I will see you next week.